Okay, so for this video, we'll have a look at Louis Vuitton, the biggest company that is present in any European exchange, the behemoth in the luxury goods industry when it comes to leather belts or jewelry or liquor or watches or whatever you can imagine in the luxury goods industry. Louis Vuitton is probably playing a part of it. And recently as well, it actually was announced that Elon Musk, the founder and CEO of, or not the founder, sorry, but the CEO of Tesla and SpaceX and recently Twitter, was no longer the most rich man in the world. Instead, it is the CEO of Louis Vuitton. So clearly they've been doing something right. They are the biggest company in Europe. It's mostly a family, well, not a family-owned business, but the family is mostly running the show there. So let's have a look actually at their numbers and see what they've been up to in the last 10 years and see if we can project that into the future. Maybe it's a good investment for us, maybe it's really not. Let's have a good look. So looking at revenue, we can see here that they have been growing drastically 10% a year, year over year, which is crazy. It's crazy. It's absolutely massive growth. It's no secret that they are the biggest company in Europe, and it shows in their revenue growth. Over here, it was slightly stagnant in the first 4 or 5 years of our spreadsheet, but then they really start ramping up, and especially the COVID blimp as well. I mean, everyone got a stimulus check, everyone got some spare money, so I mean, why not spend that on luxury watches and other luxury goods like Pokemon cards or, of course, a nice leather belt. Looking at that earnings growth, we can see that they've been growing from 6.5 billion all the way to pretty much 20 billion, honestly. In 2021, a 73% increase here in the final year. All the years prior, they've been a bit more stagnant when it comes to their growth. So quickly, let me just put in the number here. If this COVID blip wasn't here, they still would have grown on average about 7%, which is of course drastically increased with the COVID. Looking at their debt levels, there's really nothing at all to talk about here because their debt is very low. Even in 2012, they could pay their debt off with just 1 year of earnings easily, 2/3 of an earnings year, really. And the same goes for 2021, where even in half a year, they can pay down the entirety of their debt. So good for them for being very unleveraged and a very safe business to invest in. At a certain point, when you're growing this big, and we see the same for companies like Apple or Microsoft or Meta, they just have so much cash on hand. They don't actually need to incur any debt because they don't know what to spend their money on. They just have way too much money. So what they'll do then is acquisitions. So looking at the cash on hand is actually quite similar to their debt level as well. There's only one more interesting thing here, which is in 2020, where they have a lot of cash on hand. So this is cash that they did not divvy out to investors. Instead, they decided to keep it because their debt level hasn't really grown. Well, it's actually grown a little bit. I'm going to take that back. They have borrowed a little bit of money, but most of it is just because they decided not to divvy it out to investors. And they actually used this money. I have it over here. They used it to acquire the company Tiffany & Co., which is an absolute massive jewelry industry, which was located in the United States, and they acquired that in 2020, which is also part of the reason that we see such a massive revenue and earnings growth in 2021, on top of the COVID stimulus, of course. So looking at their market cap, we can see it's also been growing quite steadily, especially from 2017 onwards. This is where we really start to see their multiples expand. We look at enterprise value, it tells a similar story, because their debt and cash basically cancel each other out, which means that enterprise value is basically in line with market cap, which means the entire value of this business is basically derived from the value that is on the stock market. Looking at EV/EBITDA, now this is the amount of earnings years it takes for them to pay down the entirety of their company. And it shows here in 2015 that they had an EV/EBITDA ratio of 8.8 times, which means in just 9 years of their earnings of 8,000 a year, they could purchase back the entirety of their company, and they are not a small company, right? So this was an amazing year to start buying into the stock for sure, because this multiple is quite low for the amount of steady revenue that they have, as well as the big brand awareness that comes with Louis Vuitton. I mean, they're known pretty much everywhere. But yeah, this is where they started expanding all the way up to 24 times in 2020 and 19 times in 2021, which is mostly because their earnings just came up so much. Because it's not like their market cap has been decreasing, their share price has been appreciating, but their earnings have just been appreciating a lot more, which is very good to see. Good for them for really capitalizing on what was going on during the COVID pandemic, as well as making the acquisition of Tiffany's & Co. So looking at debt level, honest to God, there's nothing to talk about here because the debt level is as small as can be. They have no risk of bankruptcy, not even close. So we're just going to go past that. Looking at the cash flow from operations, all the money that they make simply from running their businesses, simply from running all the stores that they have, the many clothing stores, the many jewelry stores, the whiskey distilleries, everything that they have. This is all the money that is being generated from those businesses, which we can see went from 4.5 billion all the way to 18.5 billion, while at the same time the capital expenditure, so all the money they need to put in to maintain their business, you know, a new bit of paint for their storefronts, updating their machinery, updating the tills in their shops, upgrading anything really to keep the business running. Those costs have not really come up nearly as much as cash flow from operations has been, which means again that, oh sorry, not again, which means that their margins are very much growing. They're becoming more effective in running their business. And cash flow from operations, of course, the creating of all their products, the creating of their watches and anything is included in that as well. So of course that's taken into consideration. Capex is really just everything that is required on top of that to really run their factories and run their stores and everything they need to keep the business running. Looking at free cash flow, it tells a similar story to the cash flow from operations. Grown 21% year over year for the last 10 years, which is mostly, again, of course, because of the final COVID blimp. Now, free cash flow is always one of the more interesting things for any value investor anyway, not so much for a growth investor, but for a value investor, long-term investor, absolutely, because this is your pro rata ownership of the company. This is the share of the company that you get paid out at the end of the year when they have made their profits and they've done all their expenses. This is the money they have left in the vault, and this is the money that is either going to acquisitions or is going to you as the shareholder. So looking at the share number, it's actually completely flat, so not much to talk about over there. These are the shares that are in circulation right now, which leads me to the free cash flow per share. Now, because their share count has been stable, it grows in line with the free cash flow increases that we've seen in this column over here. Price per share. This is the price that is on the stock market every single year at the start of, sorry, at the end of the year. So it started at 138, which was quite a stagnant growth here for like the first 1, 2, 3, 4-ish years, maybe even 5, 6 if you want to count these with them as well. Because there's not been much growth from 2012 to 2018 onwards, but then they go up exponentially. They have some massive returns. On average, their prices appreciated by 20%. And I'd like to note as well that this is just price appreciation in the stock market, right? This does not even include the free cash flow that you get from simply holding the stock. But we'll talk about that later as well, because just for holding Louis Vuitton, I mean, they are a cash flow machine. They are an absolute cash cow. And that cash flow is a big part of a reason to invest into Louis Vuitton, because that's where most of the returns will be originating from, as we'll look at later. Free cash flow yield on average has been around 3.5%, which was a bit higher there in the early years. It's come down a little bit over here. Not much to talk about further there. So now we are in the business of projecting this company, which is not as difficult as other companies might be. The only thing with Louis Vuitton is that it's mostly a very established business already, right? I mean, their brand awareness is pretty much as high as can be. Everyone knows their brands. The biggest way for them to actually grow their earnings is by like what they've been doing here in 2021, is acquiring different companies to increase their revenue, because by themselves they're not going to increase their revenue that much. So yeah, the growth story here for Louis Vuitton is very much in new acquisitions. At least that's what I believe, and I think we will continue to see them do that. Now, historically, on average, they've returned about 13% year over year, which includes this last massive growth, right? So if you actually try to normalize this number, and there we go, then we can see a earnings growth of 7% if we exclude the final number. So actually, I think what I'm going to do for this forecast is I'm going to give them that number as well, which I think is me being quite lenient with their growth estimates, because again, they have to make acquisitions to really grow their company, and they made a very good acquisition recently, but do I trust for them to keep doing that in the future? Not necessarily, because I want to be conservative, and if my conservative estimates beat the stock market, that's when I'm interested. So I'm going to give them a conservative estimate, and if that beats it, sure, I'm happy. I'm happy to have a look at Louis Vuitton. Now, on average, their multiples has been around 14 times. Recently, it's been a lot higher than that. But I think for being conservative, I think 14 is a pretty good number here. I mean, it's the biggest company in Europe, so it's a stable company with no debt, and it absolutely requires a premium to be invested in that company, because you get the security of not having to worry about your investment, right? I mean, they will grow and they have no risk of bankruptcy, and you pay for that. But I do think it's going to come down a little bit, if only for because it makes it easier for me to be conservative with my estimates. So I'm going to give them 14 times. So that leaves me with about 458 billion in enterprise value, which is also quite similar to their market cap. So divide that by the amount of shares outstanding, leaves me with a stock price of about 1,084 euros a share. Now, with their free cash flow, they have actually been growing it about 21%. Again, if I normalize this final number just to more in line with the previous earnings, I see an overall growth of about 11%. Now, I do actually want to note that even for this year, 2022, they've actually recorded a pretty good growth. Not exactly in line with 2021. It's going to come down because, I mean, this was just way above any previous record. Is going to come down from the COVID highs, but it's still a relatively high number. I'm going to assume the annual report is not yet out, but I'm going to assume around $17 billion. So I think what I'm going to do actually for the first year, and I think I'll do that with this one as well, just to be a bit more conservative, because I know they won't quite reach the COVID peak, is that I'm going to give them a minus 10% EBITDA growth for the first year. I think that's only fair. And then going to project them from there. So that actually also means that the enterprise value model is going to come down quite a bit, right? Because, I mean, they're not going to grow 7% from the already record high increase in 2021. And I think that's a fair estimation for us to make here. So I'm going to give them minus 10% for the first year. But afterwards, I'm going to expect them to keep on acquiring new companies. I'm going to expect them to grow in the future. So I'm going to be lenient here and say I'm going to give them 7%. They, on average, had a free cash flow yield of about 3.5. I think that's maybe a bit low considering the premium that they're trading at right now, but I'm going to give them 4% because they are a big company. They have some leverage there to ask a bit more of a share price. So combining these two numbers, right now in the stock market, I can buy any share I want for 800 euros. They recently, actually today, 17th of January, I think this video won't come out until a month from now, but on this day they just reached a record high stock price of 450 billion euros. No, sorry, for 400 billion. They just reached a record of 400 billion today. So kudos for them for making that European record. So their stock price right now is quite high. So looking at the enterprise value model, looking at the free cash flow model, which are really quite similar to each other, I think on average the stock price 10 years from now will be 922 euros and 91 cents. Now, when we look at a compounding annual growth rate, which only looks at the stock price as it is, okay, it doesn't include the free cash flow that you as a shareholder would be obtaining, it only looks at the stock price appreciation, you will expect about 1.5% appreciation year over year. Which I think is not a good investment, and I very much, based on these numbers, I expect Louis Vuitton to come down quite a bit actually, to bring it back to normal levels, to bring it away from the COVID hype, because even with the growth projections that I have here, which I think are relatively nice to them, they're not going to give me a nice return on investment. If I want 1.5% price appreciation, I'm just going to buy a government bond instead. Like even in Europe, they return about 2% a year, which is government backed. It's guaranteed, and this is like a bit more of a gamble there. But again, because Louis Vuitton is such a cash cow machine, they make so much money. Much of their value is actually in the money that they produce. So I'm not just going to look at share price appreciation for this particular stock, and I'm going to look at IRR. Now, what the way that IRR is different from compounding annual growth rate is because it includes the cash flow that you would be obtaining year over year simply from holding the stock, right? I mean, they're going to dividend this out to investors. They might even buy back shares in the future. They haven't done that yet, but I mean, they have plenty of cash on hand. They might just do that. Every now and again, they will do an acquisition, but overall, this free cash flow belongs to you and is going to be dividended out to you. So that means that even though the share price won't increase as much, while you're waiting for the 1.5% stock price appreciation, you also get the dividends. And if we include those dividends, we actually get to an internal rate of return of 5.4%. In all fairness, still, on average, the stock market returns 10% a year, and even including the massive cash flow that this company produces into our return calculation, it's still not beating the stock market. I very much, again, expect Louis Vuitton to come down in value quite a bit to bring it back to normal levels, although I do not think it will outperform the market anywhere in the future because of just how big the company is. At a certain point, you're going to ask a premium for your stock, and this is very much what we see with Louis Vuitton. So it's the biggest company in Europe, but I do not think it's a good investment if you're looking for above market returns. If you're looking for safety, however, or you like their brands and you just want to be a part of those brands, then by all means do invest in this company. But when it comes to for actual returns, I would not advise to invest in Louis Vuitton. Disclaimer here, of course, that is not financial advice. I'm not a financial advisor. Just based on the data that I have in front of me, I don't think it's the best investment you can make. Okay, so that's all when it comes to Louis Vuitton. Thank you very much for watching. Don't forget to like and subscribe and all that good stuff, and I'll see you in the next one. Cheerio!